Well, there's obviously a lot of volatility around the Ukraine headlines, but in terms of the particular story that you're talking about, I think that there's a great value. And we bring up Simon Property because we just simply think it's one of the most misunderstood stories on Wall Street. And we're very optimistic about its forward path, regardless of market skittishness.
Does that optimism reflect a broader optimism in the reopening plays that would benefit from an economy that's continuing? People are confused by what part of the cycle we're in right now, what part of the recovery. Does the pandemic make this similar to past cycles or not? Is it sort of beating to the tune of its own drum? Curious for your thoughts there.
Yeah, I think people need to stop thinking about the reopening as if we're in that COVID context. The world is reopened. I mean, obviously not all of the world. China and certain parts are still dealing with this. Anyone trying to get a restaurant reservation here in New York City knows that things are back to normal in that context. The total dining reservations are only down 1% from where they were in March of 2019. Airline travel is only down 10% from where it was in March of 19. And we all know business travel and international travel are not reflected yet. And so I think in terms of people out and about doing what they do, which for Americans generally is spend money, I think that part of the post-COVID life is fully normalized.
And does that mean that near-term recession risks are pretty minimal?
Well, a near-term recession would not end up being a byproduct of a declining consumer, which is where a lot of people, I think, are confused. They see that 70% of the economy and the GDP metric is usually consumer activity, so they're wondering how that looks with inflation pressures and yield curve indicators. But the fact of the matter is that what we have to be concerned about going forward is business investment. This was the part that held the economic growth down post-financial crisis for years, is we weren't getting enough capital expenditures. We didn't see a lot of industrial production, manufacturing, those metrics. And I think that what we have to see is strong business reinvestment. And we can't get that until we get clarity around this monetary side. So in a lot of ways, the Fed normalizing will help produce normalization and allow normal business reinvestment to continue.
I haven't heard that take, and that's interesting. I don't know if you could extend that to the market. Are there stocks that would benefit if that starts to play out, and how will we know, or what would the ramifications be?
Well, of course, what you and I care about most in this context, our conversation, is stocks. But I will say what people would benefit from the most, Kelly, is overall economic growth. And that's what would happen if we finally got sustained business investment. The reason we don't get it is excessive indebtedness and a Fed that has continued to coddle asset markets. So if the Fed can get to some degree of normalization, I'm not saying that they will, but I really hope they will. We need a Fed funds rate higher than 0%. We need a 10-year higher than 2 or 2.5%. Nobody believes any growth is coming. And so people are constantly rooting for the Fed to continue giving the market morphine when what the economy needs is a lack of dependency on that morphine.
Shepard Smith here. Thanks for watching CNBC on YouTube.